Alrighty, let's kick off. Welcome everyone to our monthly webinar on Spotlight on Australian property hotspots. Michael Beresford's my name. I'm one of the four partners here in the business at OpenCorp and the Director of Investment Services. What I want to share with you today is not only information and data-based information on where we see the Australian property market right now, and specifically a deep dive into some of the hotspots. I want to be able to share with you not just the information currently, but what is the process that we go through to actually identify these hotspots. We're very proud of our track record. We've well and truly beaten the market over the last 10 years. It's due to our process, and I'll be taking you through exactly what that is today as well. In addition, we think it's a really exciting time in the Australian property market. We were very confident and transparent with our client base that COVID wouldn't have a significant impact on the property market from a price drop perspective, nor from a vacancy perspective with regards to what we invest in. We'll be exploring that, but more importantly, what are we seeing over the next few months and into 2021 to have us well positioned to take advantage of the inevitable upswing that always happens after a downturn. So when we catch up with our clients one-on-one, we generally spend the first half an hour or so focusing on you. What is it that you want to achieve? Where is it that you want to go? What do you want your investment portfolio to create? Because let's be honest, the only reason that we invest is to be able to create financial security down the track. The only reason we are experts in investment property is because it is the safest and most secure way with a proven approach to create wealth long term. If you're after get rich quick, I'm sorry, ladies and gents, go and buy a Tats Lotto ticket. That's not what we have today. We have a proven process, but it does take time to achieve it. Effectively, what we're doing is taking advantage of compound growth. I don't have time to delve into exactly what compound growth is and how it works today. We have covered it in previous webinars, and my team can take you through that when we deep dive into your individual situation and get to the next level of detail. But because we can't look at everyone's individual situation in a webinar environment, what I wanted to cover off is very quickly, right up front, who we are and what we do. The reason for that is as Cam and Matt and Al and I were cutting our teeth in the property investment space 20 plus years ago, we went to a lot of seminars, and I used to find that I'd really enjoy it up until lunchtime. There'd always be the little person in the back of my head saying, right, what's going to happen after lunch? The doors will be locked shut and I won't be leaving till I sign something. I want to remove that little person in the back of your mind so you can sit back and take in all of the content that we want to share with you today. And I'll warn you, I'm going to move pretty quickly. It's going to be rapid fire. I've got a lot to cover with you, and I want to make sure that we're creating as much value as what we can in the 90 minutes today. So very quickly, who are OpenCorp and what do they do? We are basically your investment property powerhouse. We are your mentors, guiding you start to finish, creating a long-term relationship. And the reason for that is because one property is definitely going to be better than none. One property, though, is not going to create the financial freedom that you need to be able to meet the financial goals that most Australians have, like putting their kids through private school, buying the dream home, having the choice and flexibility to work later in life and creating a passive income. Maybe some travel in there as well. They're the most popular things that I've heard over the last 10 to 15 years. So everything that we do is executing and taking the heavy lifting away from you around what our strategy is. With regards to what you can see on the screen there, we have a research and acquisitions team in-house. We are very different from most property investment companies. We are not a developer. We are not a builder. We are not a real estate agent. What we are that research team that is identifying against our criteria and our process where it makes the most sense to be investing at any point of time. Like I said, I'll share with you the process so you can take away and do it yourself if you wish. We think it's about 200 hours to get it exactly right. Clearly, not everyone has 200 hours. If you want to partner with us, we can do the heavy lifting for you. Not only that, we can set your finance up the right way. And in addition to a brokerage, we also have property management in-house as well. Property management is some of the best money you can ever spend. No one wants to be dealing with blocked toilets at 2 a.m. and doing their own maintenance. It's tax deductible. We have that in-house as well. But most importantly, I talked about that long-term relationship and journey that we want to be helping our clients on as they continue to build their portfolio over the years ahead. The education won't stop today. It won't stop next time. It doesn't stop at all. The analogy I like to use is it is impossible to turn up to your first day of prep and pass year 12 maths that first afternoon. We can't teach you everything in 90 minutes, but we can be holding your hand long-term as we go, teaching you more and more based on the experience and same strategy that we've applied ourselves. As I said, we do everything for you. We consider ourselves to be the experts, so we de-risk it. We provide guarantees and protections against the things that can go wrong, so you can just budget effectively and not have any nasty surprises. There are a lot of people to deal with through a property journey. We make it really simple through our relationship management model, I should say, single points of contact, and our strategic portfolio management is all about that hand-holding over time as you build your portfolio and review your portfolio on a consistent basis moving forward. So that's effectively what we do. In addition to that, we also believe in having some fun. You can see here, part of that Mentor for Life program is the ongoing education. You can see bottom left-hand corner, that was our client night in Sydney, over 200 clients, getting a full market update from us. We did the equivalent this year via Zoom last week for obvious reasons. We had 500 clients online from right around Australia and even a few overseas, giving them specific up-to-date information on where we saw the markets, what the outlook looks like for the next year ahead, and key trends that we're seeing, data insights, and so on. So as I said, the education doesn't stop as we go, but we believe in having some fun along the way as well. Okay, so why are we here today? One of the things that I am really passionate about is helping people understand the difference between fact and hysteria. For those of you that have tuned into some of our webinars before, or maybe seen some of our WOD videos on our YouTube channel, you'll know that I'm really passionate about helping people understand the motivations of the media. Now, the media's motivation is to sell papers and sell clicks, because that's how they make their money. As a result, if we actually look at what influences property markets, we find that the fundamentals are generally pretty consistent. They don't change on a week-to-week basis, nor month-to-month basis. But if we were to write about those fundamentals, it wouldn't sell papers because it's pretty dull and boring, okay? If I was to say, you know, the property markets are pretty stable, the fundamentals haven't changed in the last 3 years, there have been some minor changes to lending policies, and those will continue to change, but overall we're pretty stable, and supply is exceeding, demand is exceeding supply, hence why we haven't seen a market crash through COVID. I wouldn't click on that, you wouldn't click on that, people wouldn't buy the papers. So hence you see all these sensationalist headlines. What I want to do today is take it away from the headlines, because the number of times I've heard over the journey people say, if only I'd bought that property 10 years ago, if only I'd bought that property 20 years ago. Why don't they? Because we get most of our information from the media, and it distorts our thinking around what's actually happening in the property market. So what are those fundamentals? Before I get into this, I've talked about the media's motivation. The least I can do is be transparent around OpenCorp's motivation. We charge a fee for service. Yes, we do everything for you. Yes, we provide some guarantees and inclusions, so there's nothing else for you to do. Our main motivation, though, is that you get great service and that you come back and you get your next property and your next property and you build a portfolio with us. Because we're providing a lot of ongoing information to you at no extra cost. So unless you're seeing results and great service, you're not coming back and you're not telling people about who we are and what we do. And we are very proud that since we started, half of our business each year, give or take, has been repeat clients and referrals from our clients to people in their network. So that's how we stay accountable. There are my vested interests to get you results and provide great service. That's what we aim to deliver through our team here at OpenCorp. So let's have a look at the 5 fundamentals that really drive property markets. The first is interest rates. Okay, the reason why that is so important is because basically what people earn and what they can afford to pay determines house prices. So if interest rates come down and affordability improves, that can support higher house prices. If you take nothing else away from today that Matt Gross or I talk about, I want you to remember that the only thing that drives property markets at the most basic level is supply and demand. Okay. With interest rates dropping down, that's more demand because more people have more borrowing capacity. Population growth is effectively demand, and development and building approvals are effectively supply. I'll get to that a little bit later on. Just like with interest rates coming down, lending policies and how much buffers banks build into their calculators directly affect how much people can borrow. And finally, government infrastructure and spend, including stimulus, injections of capital into areas to be able to support higher population and to be able to stimulate certain sectors of which housing is a key beneficiary, the reason being that it has so many other tentacles into the marketplace in terms of retail, white goods, etc. If someone builds a house, they need a dishwasher, they need a washing machine, they need furniture, dining tables, couches, and so on. So they are the 5 fundamentals. Again, you don't hear or see too many news articles focused on these 5 things. It's all about the booms and the busts. These are the fundamentals, and that's why we've got Matt Gross on board. I introduced Matt as part of the video. I had a great discussion with him about 3 weeks ago. I hope you enjoy it. Well, as part of this month's webinar, we've got a really interesting interview to be able to share with you. I'm with Matt Gross. Matt is the director of the National Property Research Company. And Matt's a bit of an economist with a difference. Over the last 6 months, I've obviously talked to Andrew Wilson, the ex-chief economist of the Domain Group, and also Tim Lawless, the head of research Asia Pacific for RP Data. So as you know at Opencorp, we're into our data. Matt's a little bit different. I'll let him introduce himself as well. But Matt, thanks for joining us, and really looking forward to the chat today.
Yeah, welcome. Thanks for having me on board.
Excellent. Could you maybe just give, as I said, you're an economist with a difference. You're based in Brisbane, but can you just share with our viewers who you are, what you do, and how you're different to other economists out there?
Yeah, right. Okay. So let me give you sort of a bit of background on who we are and what we do. So I actually started National Property Research 21 years ago. So, I mean, what a year to turn 21 with a pandemic. Great. No partying at this end. But look, we are different. There's no question about that. You know, we've spent our 21 years doing property economic work for federal government, local government, state government, big private developers. But we bring a unique set of skills. So our training, whilst in property economics, we also have degrees in sociology and urban geography. And from our perspective, that's a really important difference because economics is a really dry subject and it's very numbers oriented. But what it fails to understand is that those numbers are driven by people. And if you don't really understand how people work in society, you kind of miss some of the drivers for how the world is put together. So we would think that the sociology background and some of those humanities studies are really, really important for when you look forward and understanding some of those trends that the numbers don't necessarily bring out or sometimes lag, in fact.
Yeah, absolutely. And we're really big on helping people understand that, a lot of data and charts out there are interpretations of those numbers of the writer. So that's part of the reason why we're so keen to get you on today. So let's rip into it. In terms of the market today, how are you seeing the different capital cities? And in your opinion, which ones have potential?
Right. So if we, why don't we start from the top and work our way around? So if we start at Darwin and if we go anti-clockwise. So if we look at Darwin had an enormous amount of growth probably over the last 3 years, which and slowed down probably the middle of 2019, but that was at the conclusion of fairly substantial gas works that were going on. So if you're looking to invest in Darwin now, you're probably looking at a falling market rather than a rising market. You know, there's a little bit of oversupply issues, really expensive to get into. And again, if you look at that people side of things, they're starting to see a migration of people out of that city. So that demand side of things probably got to work its way through the system over a couple of years. If we look at Perth, Perth has, you know, they've been calling grassroots, I think, for probably the last decade. I think those grassroots are finally starting to bear fruit. The market hasn't done much when you consider where it was at the peak of the boom, the resources boom that was in sort of 2012, when the median house price was in fact higher than Sydney. Now, that should never occur. And as a result, what we've seen is the Sydney house price, the Perth house price come back, stall, volumes have slowed. And we've also seen an out-migration as the resource boom tapered off too. So they lost a reasonable amount of people, certainly not on the scale that Sydney does per annum, but we've now seen everything sort of equalise out there. And it's a market that's really worth investigating. It's really worth shining the spotlight on it and finding some of the key markets there, because you can buy really well fairly close to the city. So it's a market that's undergoing gentrification. It's got a lot of investment from government, and they're looking to diversify their economy more broadly than just the iron ore basis from which it has. And I think you'll see tourism grow there as well. So we like Perth at the moment. We've probably liked it for a little while now, and it's probably one of those things, if you continue to say it's going to get better, sooner or later it will. And I think we've probably got to that point now where it will. So that's a market that we like. If we move into Adelaide, look, Adelaide is it's a quirky little market, and it is little by East Coast standards. Prices are really affordable when you consider East Coast prices, but if you look at what the earning potential is in Adelaide, it's probably on par with Brisbane in terms of affordability, but the outlook is probably not that great. So a lot of the young people that go through there and go to university and all the rest of it tend to migrate east across to Melbourne. So Melbourne's a major beneficiary out of Adelaide. Adelaide is an ageing population, and if you're in that retirement space or manufactured home park space, fantastic. It's a really strong outlook. But if you're looking at it from a general perspective of buying an investment residential property, there's probably better places to look. And some of those would be, I would say Perth and probably Brisbane at this point in the cycle. If we move down and hop across the ditch there to Tasmania, Hobart's had a really strong run. Their prices have been solid, their sales volumes are up. But the thing that you always have to remember is that, not just Hobart, but Tasmania actually has a gross state product lower than that of the Moreton Bay Shire Council in Brisbane. So we're not talking about big markets, we're talking about really tiny markets. So they fluctuate quite significantly, and they stay stagnant for quite long periods of time. At the moment, we're probably seeing it start to plateau. But there is an affordability aspect there where some of the people that were living in Melbourne are retiring down to Hobart because they get a benefit into their superannuation. So Hobart, look, it's an interesting market. It's a very small market. It probably needs a little bit more than healthcare driving it. But, every market has their own sort of little familiarities, I guess. If we jump across the ditch back to Melbourne, look, Melbourne's a great city. When you think about where it sat in the early 1990s and was effectively broke, they have reinvented themselves time and time again to be considered one of the best cities in the world. And they've done that through sport, they've done that through infrastructure, they've done that through cafes. So a really exciting destination. Probably a little bit overcooked, we would see at the moment in terms of the apartment market. There's a lot of supply coming through. There's a long lag in land construction, which has really hurt really, or has a potential to hurt that market in the short term. When you've got a development cycle that's lasting sort of 30 months for people to be able to buy a block of land and settle on it, many people speculated and were buying land on the basis that the price was continuing to go up and sell it on Gumtree. Now, that's not a sustainable model. But you'd also have to say that Melbourne is very fast becoming an international city in its own right. And we often consider Sydney to be an international city. But Melbourne, has always been regarded as having old money. They've had a manufacturing base which has generally held up pretty well under global pressure. They're a flat city, so the ability to expand is something that really constrains Sydney and Brisbane from that matter. We've got Great Dividing Range sits on our doorstep, and yet Melbourne doesn't. So the capacity to grow industrial and the capacity to grow some of those really strong economic drivers for Melbourne, exist where they don't in other places. So whilst Melbourne might have some hiccups in the short term, particularly when you look at where international migration is. I mean, international migration at the peak sort of was putting about 90,000 odd people into Melbourne per annum. Now, 90,000 people translates to, we'll call it 300,000 jobs. Now, that is a significant boost to any economy, and it drives retail, it drives schools, it drives all of the things that make economies work. Now, with closed borders at the moment, that's not doing anyone any favours. So from our perspective, we would look at Melbourne as a very strong watch, and we would be looking to see what happens with both interstate and international borders as to when we looked at re-entering that market. We'd keep an eye on the apartment supply as well. We'd keep an eye on what's happening in terms of land supply, particularly out on the fringes. And the other one that we would keep a very strong eye on is international students, because international students form a really important part of how Melbourne has evolved and what it's done to the universities. So they would sort of be key areas that we would watch. If we move further up the coast to Sydney, Sydney is, I'll just step back to Melbourne. If you look at where Melbourne has gone from its peak, it peaked in about the December quarter last year in terms of their greater median house price. And in the space of sort of 6 months where the current data sits for June 2020, they've come off about 8%. By comparison, when you look at where Sydney is, Sydney in its peak, which was sort of 2.5 years ago, has actually come back about 12% off its peak in median house price. So again, Sydney suffers from a lot of the issues that Melbourne has suffered from. International migration, again, peaked around about 90,000. It's down to about 70,000 at the moment, and probably less as we get more numbers come through. So international migration is a really important driver. Interstate migration is a non-event for Sydney. Interstate migration last year, if we look at it on a moving annual total, they lost about 22,000 people out of the state, net loss, whereas Queensland picked up about 22,000 net positive gain. I think Victoria was about 8,000 positive gain. So the majority of that population is actually starting to move up to Brisbane. And affordability is a significant issue for Sydney, and one of the reasons, I'll talk about Sydney and Brisbane together because I think they're really strongly interrelated. So when Sydney reached its peak, call it 2 years ago, 2018, you could actually buy 2 houses in Brisbane for the price that you could a house in Sydney. And if you're a young person, that's a really strong motivator to come up to Brisbane, particularly given that our unemployment rates are relatively solid by sort of international standards. At the same time, there's a retiree population which moves north as well, because whilst there's been very low interest rates, and that works for if you're borrowing, and particularly if you're an investor, what it doesn't do if you're a retiree is put money in your back pocket through managed funds and term deposits and all the rest of it. So the capacity to move out of Sydney and into somewhere like Brisbane, Sunshine Coast, Gold Coast, where you can sell a house for $1.5 million in Sydney and buy a mansion in Brisbane for $1 million, then you've got $500,000 you can put in your back pocket, which goes a long way to living the rest of your life. So there's some really important drivers that Sydney creates as a push factor, which become a pull factor for Brisbane. Where Sydney probably stands apart is that it is very much a world city. It is essentially, whilst Canberra is the capital of Australia, for all intents and purposes internationally in terms of trade, Sydney represents our capital city. And it has some wonderful natural attributes too in terms of harbours and, hinterland and all the rest of it. But it is a very, very expensive place to live. Its infrastructure has lagged the population growth. Very significant investment in there to try and rectify that, but that's going to take some time. And over that period of time, I think you'll find that the growth in population will tend to move north rather than sort of stay there. And, technology means that more and more people are able to work from different locations. We're seeing that right now as we podcast. So I think that there are jobs that retreated to Sydney that will actually come back to Brisbane because people can commute, by telecommunication now without any trouble at all. So Brisbane, if we move north, I think Brisbane is probably one of the markets that, not just because we're here at the moment, that we would find favourable, but it really has done nothing for 12 years. If you look at where our peak in the cycle was in the last 12 years, we've fallen 1%, so Brisbane falls 1%, Sydney falls 12%, and call it, Melbourne about 8 or 9%. So realistically, you're looking at a market that has done nothing for 12 years. There's about $30 billion, I think, in infrastructure spending in Brisbane at the moment. It's evolved a really good cafe lifestyle. It's got international cruise ship terminals now. It's got a second runway, so that will definitely liven up trade. Now, we're talking about an inland railway which will link Brisbane to Sydney and Melbourne, and that will be phenomenal in terms of driving trade in Brisbane as an inland port and both a coastal port. Population growth has been solid, and there's been no real reliance on international migration. Whilst it's been important, it hasn't had the same growth drivers that Sydney or Melbourne has had. So by default, they're less exposed markets. The other thing I'd say too about Brisbane is that Brisbane didn't go into the pandemic cycle with any oversupply in broad terms. We had a hangover of some investment apartments that they're still working through the system. That was that peak of that investment cycle that ran from 2014 to 2018. But if you look at general housing supply, it's really tight. Our vacancy rates are more often than not under 2%. If you look at our fringe urban markets, they've had incredible sales throughout the pandemic, in fact. And part of that was, I guess, driven by federal stimulus in terms of the home builder. But the real interesting point is that the market had turned around before that. All that the home builder stimulus did was just add fuel to the fire. So there was that feeling that 2020 was going to be a very, very good year for Southeast Queensland. And I think what has happened with the pandemic is that it's made things pause. It hasn't made them stop. And I think when we get out the other side of this pandemic, the growth that was expected at 2020 at the start of the year will more than likely continue on out the other side of this. So that's kind of where we see the markets at the moment in terms of a broad wrap.
Yeah, excellent. Thanks. And as you were talking, I like to help my clients understand how the data kind of relates into human examples. And a client of mine did exactly what you were talking about. Sold a house in Sydney up here, bought a much bigger, nicer house in Brisbane down here, pocketed a few $100,000 in cash, and actually got a pay rise to move on the back of the job creation. So they were well and truly better off, as an example of that net interstate migration that you were talking about.
Yeah, that's right. I mean, affordability is an issue, isn't it? Like at the peak of the cycle in Sydney, you had 30 suburbs with a median house price over $3 million. I mean, I didn't know there was that much money in Australia, let alone 30 suburbs. So there you go.
Yeah, indeed. So thanks for the runaround, Matt, with regards to the market. So what I'm hearing is obviously oversupply of apartments in numerous capital cities is a problem. That's something that our long-term followers will be aware of, because we definitely focus on land-based investments in existing and established suburbs close to infrastructure and jobs is really what our strategy is focused on. And Melbourne from a long-term perspective, and from a shorter-term perspective, Brisbane and Perth are really where the opportunities are. So, if we could maybe drill down into those three capital cities. You mentioned quite a few things in that brief. For, I guess, our investors that are starting out, I might just call out a few of those key drivers of growth that you mentioned around supply and demand, interstate migration, overseas migration, affordability, government infrastructure and spend, you mentioned as well, lifestyle. Was there anything else that you had to add specifically around Melbourne, Brisbane and Perth, and where you saw those key drivers of growth influencing those markets short, medium and long term?
Yeah, so in terms of economic pointers, is that what you're sort of looking for? Or
yeah, because I guess we find that the newspapers are there to sell clicks these days, and there'll be a headline that is emotive in its goal, and the content is 99.9% of the time not focused on the fundamentals that drive housing market. So given that that's how a lot of people consume their information, they get the fear-based message in the newspaper, decide to pause and then they jump in when they feel more comfortable. By the time the media tells you what's going on, that upside that you were specifically talking about, in terms of the 2020 potential in Brisbane flowing into 2021, you don't get penalised for being too early in a market and playing the long game. You get penalised for waiting and jumping in too late. So, which is the
Hobart equation.
Sorry?
Then that's the Hobart scenario at this point.
Yeah, exactly right. So was there anything else around people movements and that sociology kind of background that you guys have got that you're seeing even within capital cities?
Yeah, absolutely.
What determines where the population's going to go, and what are those kind of indicators that investors need to be looking at to be pinpointing the right spots to invest?
Yeah, good question. All right, so let's focus on a few of those things. Some of them will be broad and non-specific to location, and the others will be specific to location. So, infrastructure is a really interesting one. We talk about new infrastructure being, say, public transport, and maybe it's a new bus line or a new train station or something like that. The simple reality is you talk about, as a very good point you made, being too early or too late. What we know through numerous studies is that investing near public transport is always a good thing, but you actually get your capital growth before that infrastructure is built. So people get in early, drives the price up, the infrastructure comes and price stabilizes. So infrastructure is one of those ones that you really need to watch. And if you see different cities have different strategies. Perth historically has always led development with infrastructure. So they will put in the roads and rail and all the rest of it, and then development will follow, which is a really good sort of strategy. Brisbane, by contrast, will have the development happen and then retrofit the infrastructure around it. Melbourne sits somewhere in between, and Sydney's probably more closely aligned to Brisbane. So if you are an investor and you're looking at infrastructure, one of the things you need to be thinking about is when that infrastructure is going to come, because invariably your capital growth will come prior to that infrastructure actually being built, as we sort of stated. So that's one of the things that we would look at. But infrastructure alone is not going to give you the best results, because there's a whole bunch of other factors that go with it. You can have really good infrastructure and land that is there forever and a day. And if you have an enormous amount of land supply, then really you don't have diamonds, you kind of have quartz. And there's a lot more quartz than there is diamonds. So you need to be looking at those areas where the supply side of it is relatively constrained. And sometimes that can evolve around city centres where there's a push to go to higher density, but the market may in fact start to push back against that and look towards housing product. Now, all cities are sprawling. You can't get away from that. Even if you have regional plans, and most capital cities now have a regional plan which determines where you can build and where you can't build. And that has inflated prices. So land now is a really constrained commodity. Prior to any regional plans, if you could make it stack, then you could build it as long as you could get the infrastructure out there. Now there's a greater demand for short-circuiting infrastructure to a boundary. And what that's done has meant that every developer in the country now knows where you can develop and where you can't develop. And what's that done has actually made the land price escalate. And it's hard not to see that continuing because that horrible old expression of land, they're not making any more of it, is very true. They're not. And if you put an artificial boundary around a city, then that land is going to become more and more highly sought after, and highly sought after things generally go up in value. Now, the other thing that I would say is don't treat property like shares. Property is a long-term hold. It's a medium-term hold, and if you can make gains in the short term, fantastic. But you shouldn't be looking at it as a short-term issue. Property is always a long-term play. And if you want to play short-term games, use a better asset class for it, because, there are other assets that have better liquidity and all the rest of it, but they also have the capacity to fall greater. The interesting thing is, you talk about the news creating those headlines of doom and gloom and all the rest of it. There's a great expression that says, if you stop watching the news, 70% of your problems will go away. And I think that there's an absolute element of truth in that. So, so looking at the news to guide you is probably the wrong thing. And as someone that, studies the statistics and the people side of things strongly, the news is probably one of the most frustrating things I can do in the day is to read it. The other things I'd say is start to really drill down into your demographics. Some suburbs you're going to find that affordability is actually better as an owner-occupier, and some suburbs are better affordability in terms of rentals. Now, you need to understand that people have various life cycles that they go through. When you finish school, one of the things you want to do, I guess, is get out of home and move in with your friends. And so that's going to drive a pretty strong rental market, and that may well be that you want to be in the city. But there is also the misconception that all jobs are in the city, which is actually not the truth, because the majority of jobs actually sit in and around the city rather than in the city itself. So you need to be looking at where those jobs growth nodes are, where those primary economic centres are outside of a CBD. Because what you will find is that you're still going to have young people that want to live there, and they will rent there and they will buy there. And there will be, as a young person, it might be that they want to be in a townhouse or an apartment because their weekends are not wanting to be spent mowing the lawns. But then they will go through a nesting phase, and they'll couple up and, they'll move out of their home with their footy mates because they're sick of them eating their food and drinking their grog. And their girlfriend doesn't like them and they're starting to think about raising a family. So that's kind of where the push is for that whole middle income, middle ring in Australia, which is such a strong driving force. And that goes through to probably about 55 to 60 years of age now, because we're having our children later and our children are living at home longer. So the demand for our urban housing product is really strong, and it's probably never been stronger. So that's not something that's going to go away. And then we talk about either the downsizes or the right sizes, and that everyone goes downsizes or right sizes. Yes, they want an apartment. That may not be the case. They may in fact want a smaller house on a small lot. And smaller houses on small lots should not be considered cheap and cheery. There's certainly that element of it, which is really good for first home buyers. But there are people that have built up an enormous amount of equity that actually want to live in something that's really flash. It's got all the bells and whistles. It's just not as big. They don't have kids running around in the backyard, so it's not an issue. They'd rather have a plunge pool or the like. So, understanding the dynamics of how a population works and lives in broad terms gives you a really good way of focusing in on what the important parts are of the trends that are going to emerge, and how suburbs gentrify, and how our neighbourhood shopping centres start to change. If you look at a neighbourhood shopping centre, A neighbourhood shopping centre will give you a very good understanding of the socio-economic status of the people that live around it. So if you look at what the tenancies are in there, if you've got a lot of fast food, KFC, Macca's sort of stuff, you've probably got a lot younger population. But if you've got good quality, Asian food, restaurants, cafes that are sit down, all the rest of it, then you're probably looking at a more affluent population, higher professional, white collar sort of in general terms, But they're really good places to start through observation. Observation is going to be, as an investor, one of your strongest attributes.
Yeah, excellent. I really like what you're saying about the local jobs, because I think one of the other things we try to help our clients and followers understand is that a lot of people's opinions or mindsets around property and so forth comes from what they've been taught from their parents, and what their parents learnt was what was taught to them from their parents. And so this belief that you've got to be close to the city because all of the jobs are in the city comes from the kind of 40s and 50s. It's a very different scenario today, as you've explained really well. So I think that's great. And the key takeaways for me, hearing what you were talking about, Matt, is make a solid investment decision based on the long term. Look to restrict your supply, be in areas of average to above average demand, and really try to, instead of trying to pick the perfect winner every time, use a set of criteria to avoid picking a loser and hold for the long term and market cycle. But over the long term, you'll generally do pretty well.
Yeah, absolutely. Absolutely. And I'd say reputable builders too. Property is one of those things. You do actually get what you pay for. So if you're an investor and it seems too good to be true, you know what? Chances are it actually is too good to be true. And I would say also on that note, as an investor, you need to decide whether you're capital growth oriented or whether you're income oriented, because there's a place in the portfolio for both of those things. At times you might want to balance out something that's going to have great capital growth but probably doesn't have the returns, and you may want something that can prop that up with probably a better investment yield. So, I don't think it's a one size fits all, and it's the problem, I guess, that we've got in society, isn't it? It's either black or it's white. Well, there's so many other colours in between those. So, every individual has their own set of criteria, and we need to be sympathetic to that.
Yeah, indeed. We that growth versus cash flow is a really good one, and it's not black and white, because that's what we talk about is, one property is going to be better than none, but one property is not going to change your life in terms of the financial outcomes that you achieve. So the ability to add these building blocks on top of each other over time only happens if the cost to hold these building blocks is not impacting the lifestyle, because guaranteed, if I had to choose between holding an extra property in my portfolio and sacrificing date night with a wife, I know which one would win out, right? So
don't say it. You're in trouble.
She's out of earshot. But yeah, so it's fitting into everyone's individual capacity and capability to get that result long term is really good.
I'll just interrupt there for 1 second. You made a point before, which is a really important point, is that a lot of our education in finance and housing comes from our parents. And our parents are probably not always the best people to give us that advice, because there's many generations that actually don't talk finances with their children. And my generation would be one of them. So I think that there is very much a need out there for honest education that's there to assist, because otherwise, one, you don't have the diversity of product, and two, you're probably not maximising the benefits that are there before you.
Yeah, awesome. That's what we're looking to do, and all of the information that you've shared with us today so far has been great. So one last question for you before you wrap. I know we've talked long term, but everyone wants to know, if you were buying before Christmas, where would you be looking?
I'd certainly be Brisbane would be the top of my list without question. Now, remember before I said, I'm looking for diamonds, not for quartz. So I will go through a whole bunch of criteria to try and find those diamonds. So I generally like things that are close to water. The closer to water you can get, the better. I think is always probably my first preference if I'm looking. Probably my second preference is going to be, where are the jobs? Where is the economic growth? Have I got good public transport? Have I got good infrastructure? Have I got good retail around that? Now, if I can put all those things together, I'm laughing, because I've actually ticked so many of the boxes. I accept that I may have a plateau in price, for a period of time, but I also know that all those attributes are what actually drives demand. I'd probably be looking for some reasonably leafy, greeny sort of suburbs as well, because there is that certain push back to environmental. And you know what? Greener suburbs are cooler, not in terms of cool factor, but just in terms of livability. Green suburbs are nice places, and generally they resonate very strongly with the public. So they're probably some key attributes that I would automatically go to. I'm not so fussed sometimes on, it's got to be this suburb or that suburb. I think that there are times when some suburbs have really escalated very quickly. So I'm more likely to look on the edge of those suburbs. So what are the neighbouring suburbs and what are the potential within those suburbs? So if I was to take some of those comments that we spoke about just briefly then, my first port of call would be Bayside, and I would go Bayside because if I've got good public transport, I've got good white collar population, good jobs, they're green leafy suburbs, and some of those suburbs have grown in price quite significantly over the last probably 3 or 4 years. And there are those that are right near it that really haven't had that growth yet. So there will be a spillover. So I'd be looking for that spillover in there. New versus old, I think that depends on what you actually got for sale in the marketplace. New gives you some pretty good advantages. Some pretty, I guess, less risk of maintenance issues blowing up in front of you. Whereas some established houses, that might be the case, particularly if you're looking at some of our old Queenslanders. Timber in our environment, swells and it shrinks and it swells and it shrinks. So, I tend to be more of a bricks and mortar man myself, but each their own.
Excellent. Well, thank you very much for all of your insights and for your time joining us today. I'm sure everyone will get a lot of value out of that. I've learned a few things as we've gone, which is always good as well. So I appreciate your time, Matt. Thanks for talking to us.
Been a pleasure. Thanks.
So some fantastic insights there from Matt. I hope you all found that useful. And what I'm going to be taking you through now, when I asked Matt around where he'd be buying before Christmas, he mentioned that he'd be using a blueprint with a proven set of criteria to identify the diamonds as opposed to the quartz. This is our process for identifying the diamonds. Okay? It's a 3-step process. We call it the MAP process. And for some of you that have seen what we've been talking about before, you've probably seen this slide before. I don't intend to dwell on this executive summary very long. I'm going to dig into some of the detail around each of these 3 stages. But for those of you that are new to OpenCorp and what we talk about, the MAP process is a process of elimination that helps us determine the optimum investment at any point in time. Why do we have this 3-step process? Because the numbers are this. Only 10% of Australians have investment property. Guess where 68% of those 10% buy? Around the corner from where they live, in the same postcode that they live in. So while that gives them a sense of comfort because they can drive past the property and keep an eye on it, I don't know a property that goes up in value any quicker if you drive past it every day. All it tells us is that these people are motivated to improve their financial situation. They don't understand how to go about property selection to find these diamonds. So the thing that gives them the most comfort with a major investment is something they can keep an eye on. As I said, one property is going to be better than none. There is a better way to do it. The MAP process is what we've been using for the last 20 years. Because we broaden our horizons further beyond our backyard, we want to be looking at capital city markets. Matt gave us the runaround in terms of the major capital cities around the country. We focus on the four main ones: Sydney, Melbourne, Brisbane, and Perth, purely because of supply and demand. We've got the least amount of land. As Matt said, they're not creating any more, and the most amount of people. Okay. Once we identify which capital city market or markets make sense at any point in time, we then drill into their areas. Which are the specific locations, suburbs, growth corridors, principal activity centres that have all of those same properties as the capital city market, with a few others around restricting supply, reducing our vacancy risk, and making sure that we've got those lifestyle factors that appeal to owner-occupiers and tenants. Only once we've got that worked out do we then look at what the specific property is, the optimum size and quality to target the demographic. Matt explained that pretty well in terms of understanding who's moving into which kind of areas in a city versus suburban houses, and the different lifestyle changes that people go through. There's a lot more than just picking a property that you like or that you might live in yourself. So let's break it down. The market drivers. What are the key things that we look at? There's a bit of repetition here, as you'll see. As I said, it's a formula we've been applying for the last 20 years. So growth markets, flat markets, correcting markets, the strategy hasn't changed. The types of property that we invest in hasn't changed either. In terms of what drives growth in a capital city market over and above supply and demand, which I've talked a lot about, Matt mentioned job creation, and he mentioned specifically infrastructure spending. Okay. He mentioned where that infrastructure is being spent, and typically the reason why it is being spent is because demand is coming into a market. So as he said, Perth is a bit of a leader where the infrastructure comes first, the development and the population come second. Melbourne, a bit in between. Brisbane and Sydney tend to play catch up once the population has already occurred. Therefore, it is fundamental to understand three other drivers, which are 3, 4, and 5 there. Part of the reason why Brisbane has a lot of potential right now, why Melbourne is favourable to Sydney, is because you get more bang for your buck. Affordability is better. And as I went through earlier, interest rates directly relate to affordability. We know interest rates are going to be low for the best part of the next 10 years based on indicators that we look at, like 10-year government bond rates. That means that where more people can afford to buy, we see increases in demand and growth as a result. The way that we look at affordability at capital city level and when we expect the cycles to move is based on the median house prices and those cyclical movements and key indicators. I haven't got time to go into the key indicators one by one, but one of those key indicators is net interstate migration. Think about why people move. As Matt said, typically Sydney and Brisbane have a fairly tight relationship. I'd include Melbourne from experience in there as well, in that people typically leave Sydney due to a relative lack of affordability and look to get more bang for their buck in cheaper capital cities. Now, obviously, all the markets cycle. That's not always going to be the case. But in terms of narrowing down the best capital city to be buying in at any point in time, this is the process that you need to be using. So, yep, we don't have a crystal ball. We don't know exactly what's going to happen, but the track record is very strong. We've beaten the market considerably, as I said, and these 5 criteria are the best place to start in terms of understanding what drives growth in a capital city market and where you are best placed to be right now. Once we've got the capital city market worked out, we then want to look at the areas, locations, and so on that drive growth. Where is the population going? Why are they going there? I don't think I really need to expand on that. Matt did a pretty good job of outlining all of those drivers. If you just had to step away briefly during my interview with him, the key things that we're looking at are lack of available land supply based on the time frame it takes developments to come to market, we're looking at job drivers, we're looking at lifestyle and amenity factors, and we're looking at where money is being spent on infrastructure specifically. One thing Matt did talk about is that imaginary boundary, I think he called it, that exists around capital cities. What he's talking about is the urban growth boundary. When you understand where residential supply can occur and where it can't, that is the best way to forecast and be able to see beyond what's on the ground with regards to future land supply. This is something that we really spend a lot of time focusing on. And as you saw from the map summary, we look at infill areas, existing suburbs surrounded by established housing with minimal supply. Amenities, they're important: school, shops, public transport, recreation, etc. I always get concerned though when someone says to me, "Oh, I'm looking at an investment in location X because there's a new Coles being built." A supermarket in isolation is not going to give you price growth. Being really close to a school in isolation is not going to give you price growth. There are far more important fundamentals that drive growth, all the things that we're going through before I've got to amenities right here. But lastly, rental demand and low vacancy rates I want to talk about briefly. It kind of goes without saying that if you have an investment property, you want to be in an area where there is high rental demand. The best way to ensure that we do that is to be in areas that are predominantly owner-occupied. So we don't do apartments. Someone always asks, do we do apartments? I want to cover it off right now. Please don't ask a question about if we recommend apartments. We don't, for a couple of reasons. Number one, next to no land content, and land is the part that grows in value. Second risk, it's easy to bring on additional supply if a new tower comes in next to your investment and another one after that. Government planning laws tend to drive where apartment development can happen en masse. That's a key reason why we avoid apartments. Another one is control. You are one owner within a whole building. Far easier to have control over a single asset rather than one of several. Finally, most apartments are rented out. That just gives us an abundance of renters as opposed to an abundance of owner occupiers. Because if we are in areas that are predominantly owner occupied, what we have is, firstly, an area that's well kept. Owner occupiers look after their houses and they add value over time as well, bringing up the values. Secondly, if we can mitigate our vacancy risk day one and know that because we don't have a lot of supply, there's always another tenant to come in if one leaves, that just gives us consistent income over the long term. And it's the way that we can hold multiple properties in our portfolio without being worried about cash flow because they're always rented. One diagram just to illustrate what I'm talking about around government planning, strategy and investment is about understanding specifically what they focus on at a state and a local level with regards to how infrastructure is rolled out and provisioned and where land supply can occur. This is an example from one of the growth corridors in Melbourne. It's in our detailed research brief. We put together a 15 to 16 page brief from our research and acquisitions team for every location that we recommend clients invest in. So all of the data and detail around the map process. This is one that I talk about a lot with clients around local jobs and around local land supply. So don't just go out to an area, have a look. Yep, it's close to what I need and I like that house, I'll buy it. You need to dig a lot deeper to understand, well, what's the potential future supply and how do I minimize my risk and maximize my chance of picking that diamond as opposed to the quartz. A specific point I wanted to elaborate on that Matt talked about was the difference that we've seen, especially during COVID and especially in the headlines, around different asset classes. There is not one property market within a particular capital city. So if we take Melbourne, for example, because that's where we're based, you could definitely tell from that interview I'd been in lockdown and not allowed to get a haircut for about 3 months. But this illustrates the point that I want to talk about. For anyone that has been reading the news, you will have noticed over the last 6 months plus, a lot of those headlines were around massive vacancies, properties being empty, therefore a market crash is coming, and so on and so forth. As you can see here, the vacancy rate in Melbourne, as it has been in all of the capital cities, has been trending up since the start of the year. So we're above 3% as far as the Melbourne capital city goes. But this is what's important to understand. The inner city apartment market has been absolutely smashed, and we've got vacancy rates approaching 8%. Let's think of why. Because the typical types of occupants in those apartments are typically hospitality workers or people that work in the city, obviously severely locked down, and more so in Melbourne than other capital cities. But when you look, jump onto SQM research, the source is there, have a look at all of the different capital cities, and you'll see that the trend is exactly the same. Whereas when we look at suburban houses, more focused on stable family type tenants close to those local job hubs, we've seen a very, very different story, where in the southeast Melbourne corridor, as an example here, our vacancy rates are approaching 1%. So the reason why we invest in the kind of properties that we do is not only to minimize our risk, but to ensure we've always got rental income coming in. And the best way to do that is by in areas of predominantly owner occupiers, where we've got limited renters, because as soon as supply stops coming onto the market, which I'll talk about shortly, then we see a real tightening, and that drives rental growth and therefore price growth, because more people look to buy as a result. And those two things are the only two things that we want an investment to do. I don't care whether you love the property that you invest in or not. What we are concerned about is the property growing in value over time and the property bringing in cash flow so that you can hold it without impacting your lifestyle as we go. So there's a bit of extra depth with some data around areas. When we get to the specific property, as I said, it's really around understanding optimum size and quality. What does that look like? What is the best way to most efficiently create the most appealing property for the target demographic in the area? My team can explain this in much more detail one-on-one. I don't have time for it today, but safe to say, when you get this right compared to when you get it wrong, the holding cost for the property when you get it right is generally half. So let's say I used some conservative rents and some very inflated interest rates to illustrate the example, and say that one of these growth-focused properties that fits all of our criteria costs you $50 a week out of your pocket. Okay. Now, that's if you do it right. If you do it wrong, then that might be $100 a week out of your pocket. Now, that's still not terrible, because if you haven't got $100 a week of disposable income, you probably shouldn't be doing this anyway. It's important not to be scratching and scraping. Okay. But if you do have $100 a week, then by getting it right for the same cash flow, you can hold two effective properties for the same amount out of your pocket as one ineffective property. So let's say that you doubled your asset value in the market and you work out the growth over a 10, 15, 20-year period. It might not seem like a big deal, but this optimum size and quality, which is exactly where OpenCorp can create value and outcomes for you that you won't be able to get yourself, is where you can really take your portfolio to the next level. I mentioned that we produce detailed data documents. Here is an example of one, 16 pages of what we go through, map, process, mapped out all of the key criteria and all of the key research around the indicators that I've spent time on. Why do we follow the map process, and why do we continue to apply it 20 years after we started? Well, because it worked even before we started with those that taught us about investment. For those of you that have read Cam's books, you will have heard of Steve, the grey-haired investor, Alan Matt's dad, that was teaching them at a young age. I had similar mentors, and the reason why we do it is because it works. I said that we've beaten the market. We had to make a submission to ASIC about 18 months ago on our track record, and the total return that we'd achieved for our clients was 10.8%. That's a mixture of capital growth and net rental yield. But when we compare that to the Australian capital cities, so all of those capital cities that Matt talked about, we've achieved 37% above that market result. Do we get it absolutely right every single time? No, we don't. Do we have a crystal ball and the day after we buy it, the market starts booming? No, we don't. But this is the template. This is the formula. When Matt said you want to apply proven criteria, whether you use OpenCorp or you do it yourself, please follow the MAP process because it gets results. And to indicate just a couple of case studies, obviously anything will look fantastic the longer that you hold it. So what I've done is I've focused a couple of case studies on locations that we were putting our clients into over the last 4 to 5 years. The reason why I've chosen that time frame is because the market hasn't been booming every year for the last 4 to 5 years. I said to you before that the MAP process works and it's above average and it works consistently depending on the market conditions. That's exactly what I'm trying to help you understand here. So Greenvale is a suburb in the northern pocket of Melbourne, clearly close to a principal activity centre, which is those job hubs and investment hubs in the suburbs. Probably not surprising from what Matt said, there have been infrastructure upgrades that have been happening and that will be continuing to happen in this corridor. Very, very limited land supply and well above average population growth forecast is what the local council are working towards over the next 20 years. We build pretty good cities in Australia, pretty good suburbs. Any existing or established suburb, I should say, with existing housing is going to have all of the amenities. This is a property that we sourced for a client back in 2015. Close to 500 square metres of land back then, a 4-bed, 2-bath, double lock-up garage house for a bit over 500,000. Now worth $750,000. That corresponds to average annual growth of 8% per annum year on year. Secondly, a completely different pocket of Melbourne. So showing you that diversification across areas further from the CBD. Okay, one of the big myths out there, as Matt alluded to when he said our parents aren't necessarily the best ones to teach us about property and about finances, is you don't have to be close to the CBD. Far better to be at an affordable level close to local jobs, which is what those principal activity centres are focused around. All of the same criteria being ticked, obviously, given it's the MAP process. Bought in 2016, a similar property, 4-bed, 2-bath, double lock-up garage on a good-sized block of land. And we've seen nearly $200,000 uplift, which is just over 9% per annum year on year in a completely different corridor of the capital city. Okay, so having diversification is important. Having spread across different locations is important. This is why, again, you don't want to be buying in the same postcode that you live in just for comfort. The comfort should come from applying a process and a proven set of criteria that we know will get results. So let's have a look at affordability. Specifically, there are 3 parts to this that I want to focus on because it is all around how the government is strategizing to regrow the economy and obviously the budget deficit that we've got. So at the most basic level, this might sound like repetition, guys. I want you to understand it. The things that drive growth in markets are supply, demand, and affordability at the most basic level. Supply is not the number of houses for sale at any point in time. Quite often in the media, the auction clearance rates are what is reported. The auction clearance rate is purely measuring how quickly people are swapping houses. What real supply gets to is actual construction activity, the development approvals and the apartment volumes or land supply that is actually coming to market in terms of new product. Secondly, demand, I've talked about, is population growth and looking at those corridors where it goes. Thirdly, affordability, I've covered in depth around interest rates and wages. So I just wanted to cover some specifics, given we think the timing now is really positive. I'm not one to create hype around you've got to buy this week versus next week. That's not how we operate. But I've just seen too many people doubt when the best time to buy is. They try to find the perfect time. There is no perfect time. The indicators that we see make now as good a time as any for a few reasons. And they all relate to supply, demand, and affordability. There's a lot of talk since the budget that we are going to be, with record government debt and things like that. Yep, it's record in terms of the raw number. It's nowhere near record in terms of a percentage of GDP. So what you can see here is over the 100 years from 1908 to pre-GFC, you can see the percentage of GDP that we had as Australian government debt. Now, to put this into perspective for you, the estimates are that as a result of all of this government stimulus that has come as a result of COVID through JobKeeper, JobSeeker, Home Builder, and a range of other government stimulus, currently the forecast is that we will get to 43% of GDP. So nowhere near the peak that we saw at the worst of post-Second World War. And we can see that at several times over the last 30 to 40 years, we've been at about 20%, just over, about half of where we are now. The big difference is that interest rates are at 0.25%. And there are many forecasts out there, including Westpac. I was on a call with the chief economist from Westpac after the budget, saying that they expect the cash rate to be reduced before Christmas to 0.1%. So basically, it's not the raw number that matters, but as a percentage of GDP, and the fact that that money is being repaid at a record low interest rate, it's not expensive for us to hold. And that's why the government stimulus has been provided, because we don't have the lever of reducing interest rates like we've had in the past to help grow the economy after downturns. Think logically about this. You can't put hundreds of billions of dollars into circulation in an economy without seeing inflation and price growth, an inflationary effect, I should say, or price growth as a result. So hence why we see a few key indicators. We look at pent-up demand, we look at government strategy, and we look at affordability and lending, which is what I will cover now. Matt talked about the short-term border closures and the impact on overseas migration and the impact that that would have in certain locations. What you can see here is the net overseas migration over and above the natural increase in our population, i.e. births. And you can see here that in several decades after downturns, there was a higher proportion of net overseas migration. The 1950s, after World War II, for example. The 2000s, after the recession of 1991 and the Asian financial crisis from 1997 to 1999. the 2010s, after the GFC. So there's a consistent pattern here. Yes, there might be a short-term impact, but we know that the population growth and the overseas migration will be a go-to strategy from the government in the medium to long term. The Prime Minister of Australia post-Second World War actually had a saying, populate or perish. And as you can see, there are very consistent methods that governments apply here to recover from economic downturns. One that specifically affects us in a positive fashion. Don't be surprised if we see price growth and substantial price growth in the next 2 years. The reason is this. Going back about 3 weeks ago, I think it was, or a month ago, there we go, time flies. This was an announcement where Josh Frydenberg announced that the excessive lending restrictions that have been in place since 2015, but especially since the peak in the Sydney market in early 2017, were going to be eased, and borrowing was going to be the borrowing power was going to be increased as a result. Just think about that Venn diagram that I had. So 2 of those 3 boxes are demand and affordability. And if more people, i.e. more demand, can borrow more, i.e. more affordability, provided we are limiting supply, that is a pretty good recipe for success. This does have to pass Parliament in March. You've got a 4-month head start. You heard it here first before that comes in and people really starting to see an improvement in their borrowing capacity. Please don't think that the banks are just going to lend willy-nilly and that all bets are off. That's not the case. They'll still have their criteria. There still needs to be prudent assessment that people can afford the loans that they're taking out. But that onus is no longer on the bank to try and protect themselves. If someone defaults on the loan, it is now the onus on the borrower. The second one is going back a couple of weeks before Josh Frydenberg's announcement. So again, a little over a month ago, Aussie Home Loans reported that in August this year, they had the record or the highest volume of pre-approvals, loan pre-approvals that they'd had at any time since 2014. It was double the volume that they'd had in August 2018. So when we talk about upswings always following downturns, a number of people just sit on their hands through a downturn. That equates to pent-up demand, and this is the indicator that we're talking about with regards to pent-up demand really coming on thick and fast. To give you a sense on what happened from the start of 2017 through to the middle of last year when lending restrictions were at their toughest, we then started to see interest rates coming down, which improved affordability. And basically the correction that the median house prices had seen through the worst of the lending restrictions were basically made up in the next 8 months. So it took 2.25 years to come backwards, and it took 8 months to come back to where it was, or very close to, before that correction occurred. So pent-up demand is a big driver, and specifically what that means in terms of what the banks are forecasting. Clearly, they know the impact that these 2 policies or announcements are going to have on prices, and this is why we are really excited. Funnily enough, the economists at Westpac are completely in agreement with the economist in Brisbane that we spoke to, Matt Gross, around Brisbane and Perth. But regardless, across the 4 major capital cities, they're expecting between 12 and 20% price growth over the next 2 to 3 years in the major capitals. There were some even more positive comments from Westpac about the fact that as this starts to happen, it may even happen sooner and accelerate on increased consumer confidence. But again, let's look past the short-term hype and let's look to the long-term fundamentals. This is all the evidence around why we feel it's a good time to be investing right now. So I really hope that's been helpful for you. We've seen obviously some insights and heard some insights from Matt Gross around exactly what's happening in Australia and different capital city markets, the people movements, what is really important, and I've overlaid that with what our success playbook looks like with regards to that formula to find the diamonds as opposed to the quartz. So where to from here? I'll hang around for some questions. Happy to take those. Before we get to that, like I said, to be a successful investor, you've got to buy property. Doing your research for the next 10 years, hoping to find the perfect property but not actually buying anything is a recipe for failure. I'll leave you with this question. If you could have bought a property 35 years ago with the benefit of hindsight, would you do it? I'm yet to meet someone that wouldn't, okay? But what if I said to you 35 years ago that in the next 35 years that you'll have this property, negative gearing will have been removed. Negative gearing will come back. There will be the recession that we had to have in 1991. 6 years after that, we'd have 3 years of turmoil in stock markets with the Asian financial crisis. Only 2 years after that, September 11 would occur, and 6 years after that, the GFC would happen. And for 3 of the next 10 years, it would be really hard to borrow money because of excessive lending restrictions. How likely would you have been to buy a property 35 years ago knowing that all of that stuff was going to happen. Much less likely. So again, if you're looking to make a quick buck, property is not the ideal asset class. We've got to be taking a long-term approach, but hopefully this has given you the confidence to be able to step out of what most people do, which is wait, try and find the ideal time, only to regret it later. We appreciate you jumping on. We hope you've learned something today, but what we want to do to help you understand what is possible for you, can our strategy help? What are your goals and what do you want to achieve, and is there alignment there? We're happy to take that offline, sit down with you at no cost and with no obligation, purely to give you the answers around what it means for you individually. I can only share generic information today around our process. We want to take that offline and help you understand what it means for you individually, to be able to look back in 5 years from now and say, I made a pretty good decision back in 2020 when everyone was talking about the negatives. So I'll take some questions now. By all means, send them through in the remaining time that we've got. What will happen from here is you'll receive an email shortly from our team. It'll have a recording to today's webinar. So if you missed anything or you want to go back and recap, you can do that. It will also have a hot button to be able to request a discussion with one of my team and an individual strategy session to look at your personal situation. It's first in, best dress. Click on the link. One of our team will be in touch. And again, that's no cost, no obligation. We're not looking at properties or anything like that. It's just helping you understand exactly what's possible for you right now, exactly where you want to be, and can our strategy help, and sharing some more details around the MAP process and specifically how we help you, the risk protections that we put in place, and what's worked well for our clients to date. So thanks for joining us. I'll take some questions now, and hopefully you enjoyed it.